Have you ever heard of the term LVR when trying to figure out how much you can borrow to purchase a property? Regardless of if you have or if you haven't, here is a refresher. Welcome back to my channel. My name is Reese. In today's video, I'm going to be discussing what the loan to value ratio is, why it's important to understand it, and how to use it in a calculation format to understand what your LVR would be in the instance of you looking at buying a property. Loan to value ratio is something that you will definitely hear about often, and it is something absolutely worth understanding because it may affect your ability to borrow. Loan to value ratio, or LVR for short, is what lenders use to describe how much you will essentially need to borrow in order to purchase a specific property. In this video, I'm going to take you through the calculation process and give you an actual example, but before I do, I just want to touch base on a few key points about this topic. There are only 3 factors which will give you what you need in order to calculate your LVR. They include the lender's assessed valuation of the property, what your deposit is, and how much money you are going to need to borrow to purchase the property. The lender's assessed value of a property is where, let's say, a bank will use a licensed appraiser to go to the home and actually do an assessment to determine the value of that property. The parameters that the appraiser will take into consideration when trying to determine the value of a home include things like the number of bedrooms and bathrooms in the property, the square meterage of living space, so that's the actual house, how much living space there is on the property, the actual land size of the entire property, if there are any additional things like sheds, pools, outdoor entertaining areas, and many other little factors. The point is they kind of consider the entire house and property as a whole, and then they determine a value based on calculations that they do using numbers that they have, which I don't have access to, unfortunately. That's how they kind of get the value or the valuation, which is what banks use as part of the LVR calculation. So that's the first component. The second component, which feeds into the LVR calculation, is your deposit size. Now, obviously, save as much as possible for your deposit because it's going to help you in many different ways in the long run. The key thing to understand here is that it's only now taking into consideration your deposit size for the purchase price of the property. We're excluding things like government fees and upfront fees. After you've made those payments, those mandatory payments, we are talking specifically about the deposit, the amount of money you have left to put towards the purchase of the property. So that's the deposit component. That's component 2 of the LVR calculation. And finally, the last thing that feeds into the LVR calculation is how much you're going to need to borrow. Now, how will you know this? You won't until you put an offer in and it gets accepted, or you put your hand up at an auction and you win the bid. But understand that you definitely will be able to roughly estimate how much you're going to offer on a property. And if you win it, that's how much you're essentially going to have to borrow minus whatever your deposit is. So that's the third component. Now, with all 3 components categorized and understood, let's go through an example to see how LVR is calculated. As always, let's make some assumptions first. Let's assume the property you're looking to purchase is $500,000 excluding all associated fees, just to keep it simple. Let's assume you have $100,000 for a deposit. Therefore, you will need to borrow $400,000 to purchase the property. Let's assume the $100,000 is your entire deposit and you have already covered all of your upfront and government fees, so they are not being considered as part of this example. It's the amount that you would be required to borrow divided by the lender's valuation of the property, which in this instance would be $400,000 divided by $500,000, which equals 0.8. Now, if you want that in a percentage, just multiply that by 100, which when you do will equal 80%. And this means that you would have an LVR of 80%. Excellent, great. You have your LVR calculated. But how does this integrate with your borrowing capacity? Let's find out. The first thing that you have to get into your head is that the lower your LVR, means the less money you're going to have to borrow, which means that the lender is going to consider your loan less risky. This is good for you because it's going to result in the lender having more confidence in allowing you to lend that money. On top of this, having a lower LVR will result in you having more equity in your property. This is a good thing because it will allow you to take on other property ventures down the line. But that's a topic for another video. On the other end of this, if your LVR is calculated at above 80%, you may or most likely will be required to pay LMI or lender's mortgage insurance. Now, lender's mortgage insurance ranges depending on how big your deposit is, and it can be in the thousands, if not tens of thousands of dollars. So it's something definitely to be wary of, and that's why LVR can be really useful when calculating it, because you can quickly determine whether or not you're going to be required to pay LMI. Now, you can get around this. There are ways to get around this, such as the guarantor scheme. I have made videos covering both LMI and the guarantor scheme, and I have linked them in the description below as a resource for you. But back to the key points is that this can see your loan size start to increase, as if you have to pay LMI, it's going to be another cost tacked on to the total cost of the purchase of the property. And you don't want this, so understanding why and how LMI works is going to benefit you in the long run, and it will allow you to plan around it. Now, that was a lot to consume. There was a lot of words said in a very short period of time, but the takeaway from this is that it's better to have a lower LVR than it is to have a higher LVR. So the higher your LVR is, not good. Lower, good. Now, for simplicity, I specifically left out some of the upfront fees and government fees associated with purchasing a property. If you haven't or don't take them into consideration when trying to calculate your LVR, you're probably going to be in for a bit of a surprise, because ultimately your LVR is going to be based off of your deposit size. That's going to be the altering factor, because you probably have a budget, which is the amount that you're going to have to end up borrowing, and the actual valuation of the property, you're going to be able to average that. But basically, how much you can save for that deposit is the thing that's going to really change that LVR heavily. Now, if you haven't factored in any upfront costs or government fees, definitely try to understand those. I have again made videos covering what these are, but just understand that I didn't go over them in this video just for simplicity. You will need to consider them, and ultimately what it's going to do is bring down your deposit, because you're going to have to pay those upfront fees and government fees as part of the buying process, which ultimately is going to mean your LVR is going to increase. The key takeaway from this video is understanding how to calculate LVR. Go and use the other resources that I have created to understand what other associated fees there are with the buying process, if that's something you're interested in understanding. In summary, LVR is calculated by determining how much you're going to need to borrow after subtracting whatever your deposit is by the lender's assessed valuation of the property. So how much do I need? How much have I got to subtract what I need? And how much does the bank think that this property is worth? Put that into the equation, and here is your LVR. Most lenders will consider an LVR of 80% or higher as a risky loan, and potentially won't lend you that money, or will be a bit more reserved when trying to figure out or decide whether or not to lend you that money. So use that calculation wisely to understand if it's going to be a risky loan or not for a lender. And finally, if your LVR is higher than 80%, you will most likely have to pay LMI unless you have a guarantor. And again, it's still going to be a risky loan. That's why I encourage you, and most people will say 20% is the sweet spot, if not more, to cover all your government fees, upfront fees, and 20% of the value of the property. That way you're going to be set, you're going to be in a comfortable position realistically going into purchasing a property. Overall, LVR is something definitely to understand, and I hope that I've conveyed what it is, how it works, and I hope that you find this video useful. I may have gone a very deep dive into how it works, but again, it's important to understand, and this resource is here for you to come back to if you ever need to understand it. I hope you enjoyed today's video. I hope that it was insightful. If you did, please consider liking and subscribing, and as always, I will see you in the next one.